The economists all over the world are talking about the soft landing, a possible solution where the US can avoid a recession or can take a slowdown without a major crash, so to say. And that would not create a systemic problem, is what the world believes. They believe that from the past 6 months, there are signs of soft landing. But what has happened is a sudden surge in the long term interest rates to 16-year highs is now threatening hopes for an economic soft landing. All the more because the exact triggers for the move are unclear. Now, what really is a soft landing? So, the word soft landing comes from aviation, where it refers to the kind of landing that goes smoothly to avoid any dangerous situation. But what is economic soft landing? This is where we are interested in. A soft landing in economics is a cyclical slowdown in economic growth that avoids recession. So, technically, recession is 2 quarters of negative GDP growth. But a soft landing is a goal of a central bank when it seeks to raise interest rates just enough to stop an economy from overheating and experiencing high inflation. So it's a point from where you can actually till where you can actually increase the interest rate and not tip the economy into recession. And what this will do is this will not cause a severe downturn. Soft landing may also refer to a gradual, relatively painless slowdown, like the economists in the past have mentioned in such a fashion. And it can also be economic specific and also sometimes industry specific, or sector specific as well. So let's try to understand. Let's go to a little bit of history of soft landing. The term soft landing was first coined by a German professor, Hermann Leibling, in 1973. Leibling worked at a college and was the top forecaster of the US Treasury when he predicted a soft landing in the mid 1970s. But we know what happened, which turned out to be horribly wrong. The recession of 73, 1975 saw unemployment peak to 9% and the GDP declined by 3.2%. So the one who coined the term of soft landing, immediately the economy came into recession and he was proven wrong. Treasury in 1973, when he came up with the soft landing phrase, the Treasury of the United States in 1973, when they came up with the soft landing phrase, we know what happened in 1973. It was anything but soft, and it was actually the worst recession since the 1930s. The term soft landing gained importance during the tenure of the former Federal Reserve Chairman Alan Greenspan, widely credited with engineering it in 1944, in 1994 and 95. Federal Reserve Chairman Jerome Powell also suggests that the Fed achieved soft landing in 1965 and 1984 and is on course to avoid a recessionary situation this time and also another soft landing in 2022. Let's take an example of a soft landing prediction which happened in 2007 2009. The US economy saw unemployment hit the peak of 10% in 2009 during the Great Recession, and the GDP slipped by 5.1%. But back in 2007, there were plenty of predictions that the Federal Reserve Chairman Ben Bernanke made, and he was going to guide the economy into soft landing, even with the implosion of the housing market in the US. So it didn't turn out that way, as everyone who lived through the Great Recession can tell you. It wasn't exactly a soft landing. In contrast, a recession followed the last 5 times when inflation peaked above 5%. So that's 1970, 1974, 1980, 1990, and 2008. Now, inflation has gone above 5% in 2022. In fact, it reached a peak of 9% at a point, and before slowing down to 3.7%. And given the definition of recession, that's 2 consecutive quarters of negative GDP growth, which occurred after quarter one and quarter two of 22. the economy was actually in a recession. The economy was actually in a recession if we see the real GDP growth. However, quarter three saw GDP growth, and all of a sudden the soft landing scenario started to come up again. The Federal Reserve has been raising short term rates for 18 months now. Now, those increases are designed to push up long term bond yields, combating inflation by slowing the economy. But the speed of the latest jump might just be the case we have to be careful with. It comes as inflation has eased up and the Fed has signaled it is nearly done lifting rates. But what has happened is this has created a higher borrowing cost all over the world. Because the economy takes time to respond to changes in monetary policy, the Fed must actually determine the pace of rate hikes. And the rate hikes from the past 18 months has been at a very fast speed, and it takes time for the economy to actually see the full effect of the prior rate hike. But the Fed not waiting for the full impact, they just kept on raising the interest rates, looking at the inflation numbers. Stock market felt the fears for 1 month, but now they have seemed to have digested the fact that there would be any serious implication of inflationary threat that economists are talking about. Now, in the recent climb in borrowing costs, along with the accompanying slump in stock prices and a stronger dollar, is sustained, which means there could be a meaningful slowdown in the US and the global economies over the next year. At least that we are sure of. The swiftness of the recent rise also increases the risk of financial market breakdowns because that will increase the borrowing costs, and borrowing costs will always put downward pressure on the corporate profits. The likeliest cause appear to be the combination of expectations of better US growth and concerns that huge federal deficit are pressuring investors' capacity to absorb so much debt. Last year's increase in the long-term treasury yields were driven by market expectations of higher short-term rates as the Fed tightened policy and by investors' demand for extra compensation to hold longer dated assets because of the fear of higher inflation. Still, the alternative is worse. If the soft landing scenario, in the soft landing scenario, the economy doesn't slacken enough to get the Fed to pivot and actually start decreasing the interest rate. So a short recession is the only thing which will invite rate cuts. That's what many economists believe. And saying that a recession is necessarily the most bearish outcome is not what the economists say. And they say that a soft landing, a stagflation type of environment where there is no growth and no Fed cuts, it's actually worse than recession for most investors. Investors are not getting a bargain at this stage, and valuations are still very high, and we all want valuations to soften so that it becomes a buying opportunity for investments. Another possibility is that a new price shock could easily unanchor inflation expectations. What I mean is that because inflation has stayed above central bank's target for nearly 2 years now and remains above pre-pandemic levels in much of the US and Europe, there is a chance that the anchoring of the interest rate at 2% might be increased. So this is what the expectation is. Now, who knows if there is an ever increasing inflation month on month, then we might just move it to 3%, and then all of a sudden it would look like it is closer to the target, and this can happen, or maybe even 4%. Who knows? If there is another shock and inflation remains above the target, this can happen. Yellen said it was premature to conclude that the US was facing a future of persistently higher interest rates. And she says that the structural forces that led us to believe interest rates would be low are actually there. They are alive and very much kicking. As the Fed raised rates to tame inflation last year, bonds and stock both fell, a departure from the traditional pattern in which investors would hedge the risk of a downturn in stocks, another risky asset, by purchasing treasury. But they are dumping treasuries, and like In my previous video, I explained how, because of that, the yields are increasing. The link to that video is in the description. Many investors had expected that as the Fed neared the end of the rate hikes, the traditional negative correlation between stocks and bonds would return. But that's not happening actually. The big surprise is that in the past 2 months, is that it hasn't happened in part because the Fed might not cut rates as quickly or swiftly as investors are anticipating. So, rocketing US government bond yields that have led to global jump in borrowing costs are now raising new risks for economic policymakers who are hoping to lower inflation without triggering a major crisis. So, with all these things being taken into consideration, soft landing may be another way of saying that we can avoid recession. So, with studying all these factors in details, it is actually looking inevitable that there would not be a recession, and we can actually do a soft landing. And the history of landing has actually failed so many times, which is another negative trigger for this economic term which was coined in 1973. If you like this video, please share, subscribe,